A huge equity market rally, GST, RERA, the US tax changes, the Bitcoin madness, state elections, politics and what not. Yes, it is that time of the year. Another 12 months have simply crossed us by. Can you believe it? Yes, 2017 is drawing to a close. Now, if you systematically simply kept your head down and continued investing in mutual funds, then perhaps you would be a very happy person today. Well, it's a good time, as always, to reflect back at the last year and, more importantly, to look forward at trends that might shape your and my wealth, our personal finances in 2008. I must say, I was going through that old episode, Feroz, and you did say, and I must put this on record, that equity is going to be the asset class of 2017, and that's how it really played out. Your first thoughts?
Yes, see, sometimes you're very fortunate in life to be able to have writing on the wall. Exactly a year back, it was times of demonetization and stuff where there was pessimism built in. There was a lot of good stuff from an economic standpoint which was not priced in. Unlike in debt, sometimes markets go ahead or sometimes they lag behind. And so it was very crystal clear as why I'd recommended 100% allocation to equity and on a radical thought.
The other big aspect of this year, and that's been the change in the interest rate regime. Started in 2015 and now we're down 175 basis points if I'm not mistaken. How is this going to impact asset classes and the way you'll manage your wealth as we step into 2017? Feroz.
Asset classes.
Yeah.
So point one, how will it influence debt? Whatever the money had to be made in a falling interest rate regime, using debt funds is already behind us.
Okay.
So moving forward, would you make too much money on interest rates falling in a bond fund? The answer is a no.
Okay.
And unfortunately, your monies which are there in fixed deposit, which don't get benefits of falling interest rates, only get hampered when interest
because
fall.
your return is falling.
So in debt, there's no portion, either fixed deposits nor bond funds will you make you money. Point two is every time there is an interest rates coming down, there's a flight of capital from debt to equity. So equity markets get propelled. Now, unfortunately, that has not happened in the last year, and fortunately for 2017, it has not happened. A falling interest rate year, generally in the past, if you analyze the last 20 years, whenever interest rates have fallen, those years, the equity markets have given 18-20% return of this quantum if there's interest rate fall. So it's very good news for somebody who's sitting on the sidelines because interest rates have fallen and that impact has not been transformed into equity market gains. So it's still waiting to happen because there's been a lot of overwhelming news and uncertainty of unprecedented steps like demonetization. So the markets are down. So point two which I'm making is it's very good for equity what has happened, but that's still not behind us and it's still stored in the market. Point three, I think real estate should have ideally got a benefit of this fall in interest rate.
But has its other problems.
Other problems which it is grappling with. So I think equity will be the asset class for 2017 because you've had a good news but not factored in. Debt had a good news, bond funds had a good news, but it's already factored in. Real estate has a good news, but there's enough bad news to undo it.
17. And here's something interesting. So for just this episode, for now, we're going to say that you're looking at an investor who's willing to take on as much risk as possible. Age is not a constraint. Other sort of liabilities are not a constraint. If you were to create a maximum wealth generating portfolio for 2017, how would you go about the asset class mix?
See, I think if somebody has to create maximum wealth, so debt is certainly not going to be a portion of that. Okay, in my opinion, not at all.
Okay.
Because especially for 2017, if you're speaking about some periods, I know it's a little aggressive, little contrarian, but I don't see merit of having debt in the portfolio currently if you have to maximize the return, if that's the objective, and you're keeping the objectives and goal setting, which is the conventional mindset of personal finance, aside for a minute. So if you come to that, equity 100%. If equity is 100%, if you have to take more risk, people immediately what comes to people's mind is let's play sectors. But I think that's the most inefficient way of taking risk. But taking risk in a more diversified fashion in a smaller company's fund will pay off significantly better than choosing the sector yourself. Now, there are some smaller companies fund which actually pack the portfolio with potential mid and large cap and they've done it time and again. So I would choose 40-50% in smaller and mid cap companies which will actually propel and will substantiate the risk taken.
money, and we are telling you where the money could be flowing in 2018. Still in conversation with Harshvardhan Rungta as well as Feroz Aziz. So, Feroz, I'm going to ask you the same question. You said that asset allocation is going to be the key. While that will vary depending on individual goals, life goals, age profile, etc., largely speaking, 2018 will be again a year of equity. Do you think real estate can make a resurgence? Where will the money be made?
See, in my opinion, real estate is going through a transformational structural change. And even if there's money to be made, would I want to be a party to it? Why do I say that? Because the cash generation in the economy is significantly lower today, and it's trending downwards. That's a big change of how we have seen real estate in our lives. Second is, it has been unregulated for years and centuries maybe, and now it is being regulated, right? Then you also have income tax, which is changing the rules for a builder's stock. So in this kind of transformational structural change in the asset, would I want to be a part of residential real estate in metros? The answer is a big no. Okay.
Because there are a lot taken. Feroz, final thoughts.
Yeah, I think the asset allocation, if I had to summarize of how I would put it across for 2018, largely should be equity. If these are long-term goals, at least 60-70% should be equity. You have to look at risk mitigants to be able to take care of the bull run. Debt, be a little more agile, be more vigilant. So on the debt side, you will make money, provided you keep an eye. On real estate, it's a complete no-no. It will continue to be a no-no because it's a structural change, and people will lose a lot of time, if not money, not making money. So that's not, the time-wise correction could be 2, 3, 4 years. That's the opinion. And gold, I don't think should be an asset class. My only last thought would be, don't get distracted with things like Bitcoins and stuff, because those are fundamentally incorrect principles on which they work. You're using a currency as an asset. It's like selling a 2,000 rupee note for 5,000 rupees. It's not fundamentally right. And from an insurance standpoint, of course, we should definitely review the insurance, which, like Harsh said, it's very, very important. We are underinsured, we are overexposed to real estate and overexposed to fixed deposit, and that should change hopefully as a resolution for 2018.
Right.
Sharia compliant.
Returns may not be as solid, but of course it gives you the opportunity to play the market and yet be Sharia compliant. Feroz, you've alluded on this a number of times in the past. So you said it's all about managing risk. And 2018 is going to be one hell of a year when it talks about risk. So you've got the budget in 2 months. You've got a number of states going into elections. You, of course, have North Korea. You've got global worries. You've got crude. You've got inflation. You've got a tightening liquidity cycle. I mean, these lists of concerns are fairly extensive. In a case like that, how does one mitigate risk? One thing that you've been a market leader in is supplying and selling options to mitigate risk. I mean, you control the large part of the option market as well. So give me a sense of how a retail investor can do this.
Correct. So firstly, of course, we'll try and address what are these risk mitigants. Rather than giving all the risk mitigants, the most preferred, the most cost-efficient risk mitigant is a 3-year put option. Okay, which is also synonymous to a nomenclature called LEAP, L-E-A-P-S, LEAPs as they call them. This is a 3-year put option. Of course, there are several methods. This, according to me, is the most efficient method of mitigating risk. Now, point 2, how does one use it and what does this actually mean to an investor? If a person has bought himself or herself 100 rupees of mutual fund, okay, which is a large cap mutual fund, he needs to buy 100 rupees worth of put option of a 3-year put option, which will cost him or her 6%, which is 6% on 100 rupees is 6 rupees. Once you've paid 6 rupees, then you know any catastrophic fall or any reason why, and there are so many reasons which you just mentioned, if there's a catastrophic event and we see 2008 with more intensity than 2008, NSE becomes your counterparty to give you the compensation of the fall in Nifty. So this is a very powerful instrument, provided you have the courage to put some money on the table as a premium to take this risk off your back and transmit it to somebody on the other side of NSE, and NSE being your counterparty because you are using an exchange platform.
How easily can a retail investor do this? Do they have to come to Anand Rathi to get this done? I mean, how does one go about executing all of this? Because while it, you might say it doesn't sound very complicated, but for a layman, this is very complicated stuff. I mean, they can hardly understand direct equities, forget understanding options.
See, I think options are reasonably simple, but they've been made more complex than they deserve to be. Like you rightly pointed out, secondary information on Google will not help you understand it to the T for you to execute something. So you will have to go to a broker. Now, unfortunately, in this segment, there is no liquidity, and very, very few brokers will be able to do this. We, a few years back, thought that this was a very important instrument for us to educate people on. And that's why, for the last 3 years, we've been doing it, is why we've become market leaders. So, in my opinion, it's important to go to a broker. And I think Anand Rathi can certainly do it for you. There are very few people. This long-dated put options are available in India from 2001. Unfortunately, there is hardly any awareness, and it's ironical that the most important instrument for an equity investor is not made available. So how can one do it? Of course, they can come to Anand Rathi, and we can definitely facilitate the explanation. And if the person is capable of understanding the process and interpreting it, then we do it for them.
I think one needs to be aware that this is not just confined to an ultra HNI, because when you talk about mitigating risk, buying options, reducing risk, most retail investors believe that this is not for them because they're not ultra HNIs, but that's not true either, right?
It's actually not true at all. The derivative segment on the long-dated side, which is very unexplored on NSE, has a minimum lot size of 75 Nifty. Okay, and that's the lot size across different segments. So that's why Anand Rathi actually has made an app and trying to digitally make this available to retail investors. So you're absolutely right, retail investors can also do this.
Right, well, it's risk, and it's not just restricted to ultra HNIs. As a retail investor, you're exposed to as much risk as any other HNI would be. So keep that in mind. You need to mitigate your risk. 2018, we still recommend equity markets to be your, sort of vehicle of investment or asset of the year, but it's going to be a volatile year, so you got to keep that in mind too.